and for your interest in the ClucasGray Equity and Equilibrium funds. Our intention today is really to run you through an update on both the equity fund, the positioning and the performance, and my colleague Andrew Vintcent will take you through that. I'll give you an update on the Equilibrium Fund and on that performance and positioning, and then we'll touch on a few macro issues towards the end. Our intention is very much to try and allow time at the end for Q&A, and so we'll get going and leave ample time for that. Just from a business perspective, nothing has really changed. Investment team very much in place, and a team of 15 investment professionals who feed into a common research and investment platform on a day-to-day basis. The business was founded, as you know, in 2005, and we describe the opportunity set ahead of us and the resources as a well-resourced investment team, small enough to take advantage of a wide array of opportunities, and that's certainly something that we try to employ in the investment strategy in both of these two funds. We'll just have one slide on our investment process called our Alpha Thesis. This is key to our investment process and a cornerstone of what we do on a day-to-day basis. Our view is that the key drivers of a share price and generating performance out of any asset relate to two key components. One is that investment's ability to grow its earnings in real terms, grow its earnings and dividends. And secondly, a second component is looking for a change in the rating or PE multiple. And as you can see from the diagram on the right, what we try to do is invest in businesses where there is real growth that is apparent in the investment case, but pay a fair multiple for the business with the opportunity for that multiple to change in a positive manner over time as the investment case evolves. And this is something that we deploy in our investment process and strategy at an underlying investment level, in an equity, in bonds, or any asset class as the case may be. What I'm going to do now is hand over to my colleague Andrew Vintcent, who's going to take you through the equity fund and its current positioning and performance. Thank you, Andrew. Are you there, Andrew?
That's a 101 error. I do apologize. Good afternoon, all. I was on mute. Thank you very much for joining us on this call. As Grant alluded to, I'm going to try to give you an overview of the equity fund. And just for those who are not familiar, the equity fund is effectively the same carve-out that exists in the equilibrium fund. So when we talk the equity here, we are talking the equity component, which Grant will talk to you later on the equilibrium fund. And we'll give you a quick flavor for how we position the equity fund, and feel free at any stage to ask questions, and we'll attempt to address them. So the equity fund we're talking about is a South African only equity fund. It's now 15 years, coming up to 15 years old, and the capability of the equity between the equity fund and segregated mandates that mirror the equity fund is just over 3 billion rand. And it's been managed in a way that is purely South African equity. But as you'll see throughout the discussion, because it's a relatively small equity fund in the context of the industry, we've tried to take advantage of quite a wide array of opportunities across the market cap spectrum. So Grant's going to drive the slides. What we've shown you here is a snapshot of how the fund currently looks, the top 15 shares on the fund. It's been quite a, as you can imagine, it's been all the global uncertainty that's been playing out over the last couple of months. It's been quite a volatile period, and we have actually been quite active in the fund. We'll try and give you a sense for how active we have been in terms of making changes. And relative to the last 14 or 15 years of history, it's been probably one of the more active periods we've lived through between Grant and I. So without going through each of these names, we've listed the top 15 shares there. I think one of the standouts to us is the number of medium-sized businesses that feature quite prominently in the portfolio. And there we would think along the likes of Truworths or Roynett or the Cull Group, Life Healthcare, and then I think another feature we'll touch on a little bit later is the number of cyclicals that we've been exposed to over the course of the last while. So what we try to show on the right-hand side is a number of issues. Firstly, when we manage the fund, we don't want to hold more than 30 shares. We're currently at 30 shares in the portfolio. And the other portfolio construction constraints we've set ourselves is we won't have a weighting in the portfolio of less than 1.5%, and we will not go more than 10%. We think those are pretty clear guardrails that we've stuck to over the course of the fund. And the reason why we won't go more than 10% in a portfolio like this is just exposing clients to a stock-specific risk that we think is inappropriate. We have breached that 10% level 3 times in the 11 years that Grant and I have managed this fund together. Out of interest, one was SAB during the takeout in 2015-16. The other was Naspers about 2 to 3 years ago, 3 years ago, when they announced an amplification of their buyback program to try and unlock some value. We had a big position that ran up to close to 10%. And the third one was AFSA, and that was more recently when bond yields really moved very sharply lower during the fourth quarter of last year, and some of the domestic share prices rallied. So those were sort of 3 examples of periods we've breached that, but we've been quite diligent in trying to make sure that we don't have stocks over that 10% level. When we look at the portfolio mix we've constructed, the weighted PE multiple of the portfolio, by our estimates, the forward PE multiple is 9 times, and the dividend yield of the portfolio is give or take 5%, the average dividend yield of the shares in the portfolio. These metrics compare favorably to the JSE. You can see on that chart on the top right, 15.5 times in the JSE and 3.6%. And we'll come back to these in a bit because we think it's an important part of a potential return that we see from the equity carve-out. So this is a chart that is to show you how we position the fund. There are a couple of takeaways. Firstly, it's well diversified across a number of different sectors. But secondly, I think we've tried to show with the significant flag that there are a number of sectors that are aligned to an improving domestic economy. And I think it's important to stress here where we were 6 to 8 weeks ago. Grant will touch on some of the macro issues a little bit later in the multi-asset, the Equilibrium Fund presentation. But, coming into the end of the first quarter before developments in Iran, the South African economy has made significant strides in firstly lowering inflation expectations, the prospects of interest rate cuts becoming quite an important theme over the next 12 to 18 months, and a lower cost of capital through lower bond yields. Coupled with the fact that we think that there has been a reasonably constructive growth story articulated, not only by companies, but also by the overall fiscus in terms of fixed capital formation that is going to be spent. So I guess the question we're all grappling with right now, and we can have some Q&A on that at the end if there's any interest, is around how recent developments have changed that potential outlook. It's undeniable to us that the valuation opportunities reside in many of the local-facing companies. I think that's been the case for some time, and we'll try and illustrate that in a few slides' time. But coupled with the fact that the valuation, just like in the alpha thesis that Grant spoke to, coupled with the fact that you've got these compelling valuations, we've been of the view that the growth prospects have looked pretty reasonable in some of these companies. So that is how the portfolio is positioned. As you can see, quite skewed towards those businesses that would benefit from an improving domestic economy. So without going through each detail, what we try to do at a business level, at a fund level across the investment team, is to break down companies into these 5 key categories. You've got the high quality structural growth. You've got attractive real growth, which are often more stable businesses that have been around a long time. You've got the cyclical plays, and I think this is one of the buckets that we think has grown over the course of the last while. Most notably on the mining space, where the portfolio is well exposed to resource counters. Then we have the low valuation turnaround opportunities. I guess this is a number of those companies that we alluded to earlier in the South African flag depiction, where you got frustratingly low valuations that have developed over time. Yet we think the combination of a reasonable earnings profile and the ability for them to see a re-rating in their valuation, plus a very high dividend yield as an underpin, has the potential to deliver good returns. And then finally, we have the NAV plays. So these are not hard and fast buckets where we're trying to have a particular percentage allocation to each bucket, but they help us in articulating where the potential returns are likely to emanate from when it comes to the investment case. And this is what I alluded to earlier. We're currently at 30 holdings. There is one holding that is likely to disappear. It's been quite stated by the company that it will not be listed in its current form for too much longer. So we see ourselves being just under 30 shares in the portfolio. We've been very active. We've exited a number of holdings in the course of the last 2 quarters. We list them on the left-hand side there. Some large, some small, some by virtue of the fact that the investment case we think is played out, and others by virtue of the fact that they've been delisted. In the case of Adcock or Metrofile have been bought out or delisted. And then we've added a whole lot of companies on the right-hand side. The added bucket include Anheuser-Busch. When we exited British American Tobacco, we bought Anheuser-Busch, which is the old SAB. We bought Nedbank, we bought Fluors, and we've added some cyclicality around Glencore and Mondi. And I guess Pick and Pay is the one that is most topical and reasonably, I suppose, controversial. And we can discuss that if there's any interest towards the end of the presentation. But I think it's in the tweaks, the reductions and the additions that we've been particularly active. Where a number of shares performed extremely well in the first quarter. Most notably, I alluded to some of the financial shares, and the likes of Motus really ran up quite hard in the first quarter. We reduced those, and we found other opportunities to add to where you've seen a dislocation of share price performance. So we've listed quite a number of names on the right-hand side there. You'll see the one that stands out is Sasol, which is both in the reduction column and the increase column. That's not a typo. During the first quarter, Sasol had got to levels that were just looking very, very attractive. We did increase it, and obviously it's been the most notable beneficiary of the developments in the Middle East. It's up between 2 or 3 times over the course of the last 6 to 8 weeks. And into that strength, we have taken a view to reduce some of that, because there is an argument that we think is quite compelling that the short-term spike in the oil price runs the risk of being temporary were there to be any resolution in the Middle East. So this is an interesting slide, we think. Firstly, it shows you on the left-hand side global equity valuations for all the major indices. I guess the standout here, and it's been the case frustratingly, I guess, for many of us for the last 4 or 5 years, is the green line on the bottom left chart, on the left-hand side of the chart, which is the South African equity indices relative to the rest of the world. So having for many years, for 10 to 15 years, traded in line with some of the global indices listed here, it is now for the last 4 to 5 years been trading at a material discount to that. So that's the context around investing in South Africa. We think that produces an opportunity, because if you go back to the alpha thesis that Grant spoke to, the 3 key drivers of a share price are earnings growth. We think the economy will get slightly better. Dividend yield, we've shown you the underpin of the dividend yield, and the potential for businesses to re-rate. And they trade at such suppressed valuations, we think all three of those have an ability to help generate reasonable returns. So on the right-hand side, we're listing at the end of April, so 2 to 3 weeks ago, we're listing the valuations of a number of these companies. And you can see it's the forward PE multiples are between 6s and 7s in most cases, and the dividend yields are 6s, 7s, and 8s. So these are businesses that really do trade at very attractive valuations, which we think is an underpin to the potential for them to give you decent prospective returns. Thanks, Grant. And then the final one, which sort of talks to the same theme, is taking 6 companies. They're very disparate companies. They've been listed for 20 years. 2 are financials, 2 are industrials, and 2 are retailers. And to take the average of these 6 companies, you just get a sense of how cheap the South African equity market is relative to its long-term history. Those 3 green shaded areas at the bottom include the global financial crisis of 2008. It includes the COVID crisis of 2020. And we really have been stuck in a very similar valuation paradigm to those periods. Not quite as dramatic, but certainly in the context of the last 20 years, there's some very attractive opportunities that we believe in time, and it's a game often of patience, in time, these will have the potential to be unlocked. I think the next slide is one that is quite busy, and I'm not going to talk through it in any particular detail, but we use this across all the companies that we've invested in to try and illustrate where the potential return from an investment comes from. The 3 shaded blocks are your earnings growth, which is a key underpin to any return, and the dividend yield, which is kind of a given. So the dividend yield is your starting yield. You're likely to earn that over the course of the investment. And you can see in most cases, adding the blue and the yellow is your earnings and dividend get you to a return in the order of the mid to high teens, which is a very, we think, a very comforting underpin to the potential returns you can generate. Where the interesting and in due course it will play out, where the excitement comes through, is the potential for the re-rating to play out as well. And what we show here is the black dot is the current PE multiples, the red dots are where we think the PE multiples can end. And whilst it's a busy slide, we've tried to simplify it by showing you these three different colors. And you can see the greeny color at the top shows you the extent of the re-rating, and the combination of those 3 has the potential to, we should have hidden the total returns on the left-hand side, but it's got the potential to deliver, we think, very attractive returns for investors over time. So that's a good snapshot, we think, of some of the ideas that we've positioned the portfolio in. And then finally, I think it's one of the last slides on the equity block, but this is one of the most illuminating studies we've seen done. It was done in December, to the end of December, by Standard Bank. It shows you the big 5 South African banks, and it shows you, banks for some time have been very well capitalized and they've been very cheap. Excluding Capitec, the domestic banks have been very, very cheap. And the best way to illustrate that attractive valuation is through the dividend yield. And you can see in this slide, the extent of the dividend yields at the bottom are so attractive. Take a bank like Absa, which has it's for some time being it's been the most attractively valued bank. Absa over the last 5 years has delivered a dividend yield of 8% per annum. Over the last 25 years, investors have received 6% of their return has been through dividends over the last 25 years per annum. And what this slide effectively shows is that adding back dividends to the total return, you can see that even Absa, over the last 25 years to December, has outperformed the ALSI and the S&P 500 because the total return is a function of your capital return plus your dividend return. And it's a very compelling underpin. So when we look at, and it's the same arguments for the last 10 years, it's outperformed the all-share index, and for the last 5 years, it's performed extremely well relative to both the ALSI and the S&P 500. And I think we think this is a very important chart to illustrate why the 3 key components of the return, being earnings, potential valuation re-rating, and dividends, are so compelling. You've got this underpin of these dividends, which we think at a portfolio level of 5% gives you some underpin to the potential return. And then the final two slides are just to talk to why we think a fund like the ClucasGray Equity Fund has a role to play. We show the current JSE portfolio construction, which is the top 20 shares make up 2/3 of the total JSE, and the next 20 shares make up another 19%. So the top 40 effectively makes up 86% of the JSE. So if you go and buy the JSE Satrix, for example, passive index, you'll get 86% will be made up of the top 40 shares. As active managers, we've tried to illustrate that we have seen opportunities away from just the large cap of the shares. And you can see that of the top 40 shares, only 57% of those, our portfolio, 57% of our portfolio would be part of the top 40. And we've seen opportunities far more broadly. So we've got 43% of the portfolio is made up of companies or investment ideas that are outside of the top 40. And it's that differentiated approach which has led to a differentiated performance, which is, if you look the same, you'll perform the same. But to outperform over time, we think it's important to try to look a little bit different. And we try and illustrate that in the next two slides, where we show our equity objective is to deliver alpha over time. But because we look different to the index, we can't deliver alpha all the time. And what we show on the left-hand side is those discrete periods where the equity fund has outperformed the market, and the blue bars below the line are those periods when it's underperformed the market. And the net effect is that over time, the chart on the right-hand side is the delivery of alpha, which we'll show you in the next slide in terms of numbers, but you can see the delivery of alpha over sustained periods of time. So the last slide on the equity fund before Grant takes us through the Equilibrium Fund is to show the return of the equity fund over the last 6 months, 1 year, all the way up to the last, since inception in October 2011. And you can see the returns, very strong returns over the more recent periods, 37% of the last 12 months. And these compare favorably in that block, the second last column. That is the difference between these portfolios and the index. So you can see over the last 6 months, the fund would have outperformed the index by 10%, over the last 1 year by 11%, over the last 5 years by 4.5% per annum, etc., etc. 3 years, the last 10 years by 3% per annum. So that's the net effect of the strategy we've tried to articulate over the last 10 to 15 minutes. And how those portfolios have ranked relative to the peers is at the bottom. So, I guess over most periods, the fund is in the top quartile of performance, in some cases, the top decile of performance relative to the peers. So that's a snapshot of the equity fund. And to reiterate, that would be, largely speaking, the carve-out of the equity within the Equilibrium Fund that Grant will talk to now.
Thank you very much, Andrew. I'm just going to go through one or two introductory slides. As investors will be aware, the Equilibrium Fund is a Regulation 28 compliant fund. So that speaks to retirement annuities, living annuities, anything governed by Regulation 28 compliance factors. And the key issue there is that one cannot have more than 75% of the total fund invested in equities. 25% and more needs to be outside of equities in a combination of fixed income assets, cash, bonds, and listed property. So that would be the key issue to talk to there. The fund itself is around about 1.8 billion rand as it stands, and we have some mandates which are aligned to managing this fund, and so the strategy assets under management is around about 2.2 million as it stands. A very key component to managing this fund over its lifetime has been our objective to try and achieve real rand returns of 4%. So we will try to position the fund into assets which we believe have a compelling opportunity to generate returns of CPI plus 4% over a period of time. The period of time that we refer to here is a 3-year time horizon. And what we are using here for illustrative purposes is inflation plus 4%. And we are using typically the upper end of the inflation band. So we are aiming for 6 plus 4%, which would be 10% over the period of time. We may make some small revisions to that given the revision of the inflation targeting, but that is not something that is occupying our minds at the moment. We are aiming for returns of 10% plus over time. What this illustrates to us at the moment is that given the valuation opportunities, the Manhattans that you see in blue are domestic assets, domestic shares, and we still see the strongest opportunity to earn inflation plus 4% returns out of domestic shares and indeed out of domestic bonds. You will see that the golden Manhattan bars show you bonds towards the right-hand side of the chart, inflation-linked bonds, which sit there at close to 8 to 10%, and then other asset classes to the left of that yielding lower returns. The Manhattans in green are all foreign assets, and so it would come as no surprise to you that we have positioned the fund predominantly in domestic assets currently, because that is where we see the strongest level of returns. Clearly, we can't be ignorant of diversification. And so if I move on to this slide and to show you the current positioning, we have approximately 55% of the fund in domestic equities, 4% in property, 25% in a combination of fixed income and cash. Cash only makes up 2% of that 25%. Global equity makes up 15%. And 1% is invested in a global dollar-denominated corporate bond. And that is where the fund is currently positioned. There have been marginal changes to this from the fourth quarter of 2025. We're probably holding slightly less equity and a little bit more fixed income and cash today than we were at the end of last year, and most of that is because equities have had a strong run up, and we were either taking profits or got taken out of one or two of the existing equities. Andrew's spoken to the equity component already, the 55%. So I'm going to spend some time primarily on the fixed income and the global positioning within the fund. An important starting point is what we see as the potential returns out of South African bonds. What we're illustrating here on the right-hand table is that our base case, as you can see with the highlighted circle there, is that we expect from today that we could still earn a return of somewhere between 10 and 11% from South African bonds. This is our estimate of fair value for the 10-year bond. And our assumptions really are that we have an environment that has inflation of around about 4%. It's lower than that, but clearly the risks to the upside exist in the current environment. And we have a base case for our credit spread to be in and around 3%. And those are key inputs to this valuation. So that is why we still have maintained a strong positioning in the fund of just under 23% in a combination of nominal, inflation-linked and corporate bonds. And we'll give you more detail of that in a minute. What we speak to here is just the exact positioning of the fixed income bucket. So I spoke to this being diversified across a number of different fixed income assets. What you'll see on the right-hand side of this chart is that we estimate that the current running yield of the fixed income component is just over 8%. And there's about 4.8 years of duration within that. As a reference point, the All Bond Index has a modified duration of about 6.5 years. So we're running at a lower duration, but also at a lower running yield, and we're trying to ameliorate some of the risks of duration by accepting a slightly lower yield. You'll see the combination of assets. The one key change which we've made to the fixed income portfolio over the last 2 quarters is a significant increase to our exposure to inflation-linked bonds. Inflation-linked bonds are still giving you a real yield of about 3.5% to 4%. And we see that as a very attractive component to the fixed income carve-out. We funded that increase in inflation-linked bonds by selling some of the nominal government bonds. Those have performed extremely strongly over the last 12 months, and we felt there was an opportunity to move some of that exposure into inflation-linked bonds. Alongside that, we also have exposure to corporate bonds. One of the new additions which we made was a purchase of a Santam new listing bond, which is a floating rate bond. So those corporate bonds make up around about 13% of the fixed income portfolio. Moving on to the global exposure within the fund. Again, we've made a few changes here over the last 3 to 4 weeks in particular. The changes really relate to the fact that we've moved far more towards active managers over passive managers. We had more ETF and passive holdings 2 quarters ago than we do today. And we think that the environment is more suited to going a more active route as things stand. The key 2 changes which we've made is we've added exposure to a US-based value manager called Dodge & Cox, and you'll see that makes up around about 47% of the global exposure in the fund. We reduced exposure to Europe and Euro stocks, which is now only about 6% of the foreign exposure. And we've halved that and increased the exposure to Dodge & Cox and to Veritas Asset Management. Those are the key changes which we've made. We've maintained a position in Japan and a Japanese manager called Arcus. So those are the changes over the last 2 quarters. Some of the rationale for that positioning, just to give you some sense of it, is that in many markets during the second half of April and the first 10 to 15 days of May, we've seen actually a very sharp recovery in certain areas, particularly in areas like technology in the US market. And so at an index level, one's still talking about a rating on the S&P 500 of 21 times as at the end of April. And there are a few points to note here. Firstly, that certainly is somewhat above a medium to long-term average. You'll see that the last 30 years average S&P is traded on just over 17 times against the multiple of 21 times. So we are trying to divert some of the portfolio away from expensive components of the market. The second point which we make on this slide, which is the bottom left-hand chart, is that we are seeing a very broad-based and encouraging earnings backdrop. That shows you the earnings forecasts and revisions across the US, the S&P 500, the S&P 600, which is small caps, as well as the NASDAQ. And whilst the NASDAQ revisions have certainly been higher than any other area of the market, it is encouraging to see that there is certainly up until very recently a broad-based recovery in earnings across various parts of the market. And that does give us some encouragement that the valuations are well supported by earnings in the current environment. Just the second slide to talk to and part of the reason why we've rotated some of the portfolio, the offshore portfolio, into different parts of the globe, is that valuations outside of the US, we think, also look attractive. The chart on the right-hand side just shows you that areas such as Japan, Europe, China, and other emerging markets are currently trading at levels which would be at or below their long-term averages. Whereas what you can see from that same table is that valuations in the US are significantly above long-term averages. We think part of that is justified from the perspective that AI earnings and the benefits from AI capex in the US certainly look to be coming through. What we're saying here, though, is that there's actually some benefit that is taking place in other parts of the world too, which we cannot ignore. So Asia's gross fixed capital investment, is expected to increase very substantially between now and 2030. And we want to be able to position the portfolio to take advantage of that, as well as other parts of the world. This chart just gives you some demonstration as to the change in asset allocation of the fund over a period of time. What we're trying to demonstrate to you here is that, as per the earlier Manhattan's chart, we are reorientating and repositioning the portfolio into assets which we think can grow at CPI plus 4%. And you just see the change in the mix and exposure to asset classes over an extended period of time. The fund, as you see, is currently very well exposed to SA equities, as well as income assets, if you compare it to changes over various periods of time. We run a bottom-up exercise looking at the prospective returns for the fund. If we take our current positioning and the potential return which we think we can earn out of each asset class, what do we think the potential returns are looking forward 12 to 24 months? The table on the bottom just shows you a bottom-up exercise. If we take our current positioning and the potential return out of each asset class, our expectation is that the fund, we think, should be able to return in and around 12 to 13% looking forward from this current positioning. The one thing that we know about that 12 to 13% is that we will be wrong. The environment is very fluid. Things are changing each day and each week, and we certainly are monitoring this closely and will make changes to our positioning within the various asset classes if we deem it to be necessary. Just to highlight some of the recent performance numbers. This is, as Andrew described earlier, up until the end of April. You'll see the fund's performance in the top row there in green. Fund up around about 9% over the last 6 months. Very healthy returns of 25% over the last 12 months. And the 3 to 5 year numbers, in our minds, are probably the more encouraging ones at 15 to 16% compound returns. And the reason we say that is that, inflation over that period of time, and even inflation plus 4%, has led to some very strong real returns, which you can see in the bottom, the bottom row there. Real returns of 10 to 12% over the last 3 to 5 years. And, even over the 10-year period, real returns of 6%, have managed to be delivered. So I think for now, we are comfortable with the positioning. And as we said, we think that returns of 25%, as we've enjoyed over the last 12 months, is not our expectation in the 12 months looking forward. But let's see how the environment changes. This is just maybe a last slide on actual performance, but just demonstrates to you the delivery of performance against that benchmark of inflation plus 4%. Since inception. Inflation plus 4 over that period of time has measured just under 9%, and the fund has delivered just under 11%. So just meeting those objectives that we have set for ourselves. We do not want to dwell on the macro environment for too long. I think everyone is pretty well versed in it. We've got 3 quick slides, and then we're going to move on to Q&A. We've tried to set out a few scenarios for ourselves here around various sets of oil prices, oil returning back to $70, oil staying in between $80 and $90 for a sustained period of time, and oil staying above $100, which is obviously a scenario that is best avoided. We think that last scenario is very negative for many asset classes. There will be some beneficiaries of that scenario, but they are limited. The likes of a Sasol, Exxaro, AECI, we think are beneficiaries, but there are far more detractors in that environment than there would be beneficiaries. The key question on everyone's mind is, of course, how long this lasts. And so we have played through some of these scenarios in our asset allocation thinking and in our minds. And certainly our reading of it, is that if this scenario, the current scenario stays, into the 3rd and 4th quarter of the year, we could move into a far more worrying situation from an inflation perspective, where central banks will certainly have to start thinking about rate hikes if the oil price sustainably stays at these levels. I think that that is currently not a scenario that we are banking on. We still see hopefully a case for a resolution and oil returning to a more normal kind of price level closer to 70, perhaps into the mid 70s. Under that scenario, we do think that central banks will be more patient in looking through short-term inflation blips and are unlikely to have knee-jerk reactions to hiking interest rates. That's going to be very much time dependent in our view. Just on the oil spike and the current crisis in the Middle East, we just make a few points here. The one is that the obvious impact is for consumer economies. There's not a lot that comes out of this that is good. It restricts consumer behavior. It's effectively a tax on consumers, and ultimately, the macroeconomic responses can be detrimental to the consumer economy. Countering that, we do make the point that the world is far less reliant and dependent on oil than it was in 2 decades ago. The chart on the right just shows you the unit of oil consumption required per unit of GDP generated. And clearly lots of developments in alternative energy and a lower dependence on oil has helped that scenario. And we think that oil crises such as these in the past have driven a move and a drive towards more energy efficiency and diversification. And we think that is a trend that is likely to continue. The bottom left-hand chart is just a chart that shows what has happened to US oil exports, which have increased, quite substantially over the last few weeks. And so the only positive to read out of this would be, firstly, for the US itself, and then secondly, that oil is finding its way to other parts of the world via Texas, as opposed to the Strait of Hormuz. So, there are obviously some long lead times and adjustments that need to be made. But we are seeing, certainly in the short term, a high level of disruption to supply chains. We'll just wrap up on this, and we need to remind ourselves of the global backdrop that we faced a matter of 8 weeks ago. And that was a global backdrop that was pretty constructive for global equities, including emerging markets. Growth was showing signs of improving. And certainly we think that there was an accommodative macroeconomic policy behind that. We are obviously very mindful of the risks of sustained or higher oil prices on the global economy and on the domestic economy. We can't be ignorant of that, particularly if this plays out for another quarter. But we've got to balance that out, with the opportunities that we are seeing. Many asset prices have reset very significantly in the last 6 to 8 weeks. And we think that those resets are offering good entry points if one takes a medium to long-term view. In terms of the supply-demand dynamics for industrial commodities, we remain optimistic on these. Commodities such as copper, we think are well placed for numerous developments, particularly around capex for the globe going forward. And we've positioned parts of the commodity exposure in the portfolios to take advantage of that. On South Africa specifically, we still see an environment, very modest starting valuations, as Andrew alluded to. And we've been pretty active in trying to recycle capital within the portfolio, both within the equity fund and in the Equilibrium Fund, to take advantage of these valuations. We still see a potential for an environment which resets back to an environment of more moderate inflation where growth prospects improve. There's enough on the macro front domestically that we think there are improvements in infrastructure spending and the potential for a pickup in growth. But as we said, we're balancing this out, being mindful of the risks that are currently playing out in the global environment. So I think we intended to leave it there and leave time for Q&A. Thank you.